There's a very common idea among individual investors that the stock market is the center of the financial universe. But throughout my career, I've learned something different. The most important market in the world isn't the stock market. It's not the real estate market either. And it's definitely not the speculative assets that make headlines every day. The market that truly governs the global financial system is the bond market. It's in this market that the cost of money is determined. It's where governments find out how much it costs to finance their deficits. It's where companies assess whether they can expand, invest, or survive difficult economic cycles. In other words, the bond market functions as the nervous system of modern capitalism. And when the system starts sending unusual signals, experienced investors pay attention immediately. In recent months, something interesting has begun to happen. Unusual movements in long-term rates, changes in the shape of the yield curve, and persistent volatility in a market that historically tends to be much more stable than the stock market. These signals are not noise. They usually indicate that something bigger is happening behind the scenes of the economic landscape. And when we analyze these movements carefully, we begin to perceive a message that the bond market seems to be sending, a message that points to a specific period on the horizon, a period that could become a critical point for the global financial system. This period seems to converge towards 2026. Now, this doesn't necessarily mean we are heading towards an inevitable crisis, but it does mean that certain structural pressures are accumulating in the economic system. Pressures related to global debt, to the rising cost of financing, and to the changing behavior of bond buyers around the world. Today I want to explain exactly what the bond market is trying to tell us. Because, historically, when this market starts signaling something important, it usually does so long before the rest of the world realizes it. And understanding these signals early can make all the difference for any investor who wants to navigate the coming years with clarity. One of the most important things I've learned over decades observing financial markets is that different markets have very different personalities. The stock market, for example, is often driven by narratives. Optimistic expectations can drive prices for long periods. Stories about innovation, growth, or new technologies can dominate investor sentiment. The bond market, however, works very differently. It is much less tolerant of narratives and much more sensitive to macroeconomic reality. In essence, the bond market responds primarily to three fundamental variables: inflation, economic growth, and credit risk. When inflation begins to rise persistently, bond investors demand higher interest rates to compensate for the loss of purchasing power over time. When economic growth slows, long-term yields often begin to fall, reflecting expectations of lower economic activity in the future. And when credit risk increases, whether in corporations or governments, the market immediately demands higher premiums to finance that debt. For this reason, the bond market frequently detects problems before they become evident in the rest of the financial system. This has happened many times throughout history. Before the 2008 global financial crisis, credit markets began to show clear signs of tension. Spreads between different types of bonds began to widen, indicating that investors were becoming more risk-averse. Something similar happened before the economic slowdown of the early 2000s. Long-term bonds began to reflect expectations of weaker growth before many analysts recognized what was happening. Today, we are again observing signs that deserve attention. First, long-term yields have begun to exhibit unusual volatility. Movements that previously took months now happen in weeks or even days. Second, the yield curve has shown persistent distortions, something that typically appears during periods of economic transition. And third, market sensitivity to public debt issuance has increased significantly. Each new round of bond issuance now has a more visible impact on rates. Separately, these signals could be interpreted as part of a normal economic cycle, but when they appear together, they begin to tell a different story. A story that suggests something structural may be shifting in the balance between debt growth and the cost of capital in the global economy. And that's precisely why we need to look more closely at what's happening now. To understand why the bond market is sending signals now, we need to look at something much bigger than the current economic cycle. We need to look at what has happened to the global financial system over the last few decades. If you look at the history of interest rates since the early 1980s, you'll see a very clear trend, a structural and continuous decline. For more than 40 years, the cost of money has gradually fallen in virtually all developed economies. This had enormous consequences. Lower interest rates make credit cheaper. Cheaper credit stimulates consumption, investment, and economic expansion. At the same time, lower rates increase the present value of financial assets. This environment helped fuel one of the greatest asset appreciation cycles in modern history. Stocks rose consistently for decades. The housing market expanded, and governments were able to finance ever larger deficits without facing particularly high financing costs. But then came the 2008 global financial crisis. To prevent a systemic collapse, the world's major central banks adopted extraordinary policies. Interest rates were reduced to near-zero levels. Massive bond buying programs were implemented. Central bank balance sheets grew on a scale never seen before. This period became known as the era of quantitative easing. For more than a decade, trillions of dollars were injected into the global financial system. These policies had a clear objective: to stabilize the system and stimulate economic growth. And in many respects, they worked. But they also created a structural consequence that is now becoming increasingly evident. The world has become accustomed to operating in an environment of extremely cheap money. Governments have expanded their debt levels. Companies have increased their leverage. And financial markets have come to depend on abundant liquidity to sustain high valuations. This model worked as long as interest rates remained very low. But now we are entering a different environment. An environment where the cost of money is no longer close to zero. And when this change happens in a highly indebted system, the consequences begin to appear first exactly where we're looking today, in the bond market. For many years, carrying high levels of debt seemed manageable for most developed economies. The reason was relatively simple. The cost of this debt was extremely low. When interest rates are near zero, governments can issue large volumes of bonds without the immediate impact on the budget seeming alarming. Interest payments remain relatively small relative to the size of the economy, and the system continues to function without major apparent strain. But this logic depends on one essential condition: low and stable interest rates. When this condition changes, the entire debt mathematics changes along with it, and that is exactly what has begun to happen in recent years. With global inflation rising after the pandemic, central banks were forced to raise interest rates significantly to try to contain inflationary pressures. This move marked the end of an extraordinarily long period of extremely accommodative monetary policy. We are now operating in an environment where the cost of capital has returned to higher levels. This creates an effect that many people underestimate. Public debt doesn't disappear. It needs to be constantly refinanced. Maturing bonds need to be replaced with new bonds. And when this refinancing occurs at higher rates, the total cost of debt begins to increase rapidly. Imagine a government that has issued large volumes of debt at 1% or 2% over the last decade. When those bonds mature, they need to be replaced with new bonds that may be paying 4%, 5%, or even more. This difference seems small at first glance. But when we're talking about trillions of dollars in debt, even a few additional percentage points represent hundreds of billions in interest payments over time. That's where the problem starts to become structural. Higher interest rates mean higher debt service payments. Higher payments widen fiscal deficits. Higher deficits require new bond issuances, and each new issuance adds more pressure on the debt market. This cycle creates a dynamic that could become one of the dominant forces in the macroeconomy in the coming years. And the bond market, as always, begins to react to this reality before it clearly appears in the rest of the economy. So far, we've talked a lot about the supply of debt. Governments are issuing more and more bonds to finance deficits and refinance old obligations. But there's another side to this equation that's equally important: the demand for these bonds. For decades, the sovereign debt market, especially U.S. government debt, has relied on an extremely stable base of buyers. Key players included foreign central banks, pension funds, insurance companies, and large global financial institutions. These investors sought something very specific: security, liquidity, and predictability. U.S. government bonds were considered one of the safest assets in the world. This created a steady flow of international demand for many years. Countries with large trade surpluses, for example, frequently recycle these resources by buying treasury bonds. This process helped keep interest rates relatively low, even when debt issuance was very high. But in recent years, we've begun to observe gradual changes in this behavior. Some countries have begun to diversify their international reserves. Others have begun to reduce their dependence on dollar-denominated assets. At the same time, certain institutional investors are reassessing their long-term allocation strategies. This doesn't mean that demand for bonds has disappeared. The market remains enormous and deeply liquid. However, small changes in the composition of buyers can have significant effects when we're talking about a market worth tens of trillions of dollars. If the traditional buyer base shrinks or grows more slowly, new investors need to take on that role. Otherwise, the market needs to find a new price equilibrium. And as we know, in the bond market, when the price needs to fall to attract additional buyers, yields rise. This is one of the reasons why we are seeing more intense movements in long-term rates. The market is trying to figure out what level of yield is needed to balance this new dynamic between growing supply and transforming demand. And this search for equilibrium may still be far from over. Now that we understand two fundamental factors, the structural increase in debt and changes in global demand for bonds, we need to observe how these elements meet in practice. This meeting point occurs in the government financing process. Every year, governments need to issue new bonds for two main reasons. The first reason is to finance budget deficits. When public spending exceeds revenue, the difference needs to be covered by issuing debt. The second reason is refinancing. Much of the existing debt has defined maturities, and when these bonds mature, they need to be replaced with new ones. This means that the bond market is not only financing new expenses, it also needs to constantly absorb enormous volumes of old debt that are being renewed. Now imagine this process happening at a time when three things are occurring simultaneously. First, fiscal deficits are growing. Second, large volumes of debt issued years ago are coming to maturity. And third, the structure of traditional buyers is gradually changing. This combination creates increasing pressure on the financing process. When the Treasury needs to issue large amounts of bonds in a short period, the market needs to absorb this additional supply. If there are enough buyers, the process happens relatively smoothly. But if supply grows faster than demand, the market needs to adjust the price to attract new buyers. In the bond market, this means higher yields. This is one of the reasons why long-term rates have been so volatile recently. The market is trying to find an equilibrium point where investors are willing to absorb increasingly larger volumes of debt. This balance depends on expectations regarding inflation, economic growth, and fiscal sustainability. And when these expectations become uncertain, the market reacts quickly. Therefore, observing the behavior of long-term yield today is essential to understanding the pressures that may accumulate in the financial system in the coming years. Now, we need to connect all the elements we have discussed so far. We have a highly indebted global system. We have an environment of higher interest rates than that which prevailed for much of the last decade. And we have a gradual shift in the structure of bond buyers. When these factors converge, a central question arises: when does the full impact of this shift begin to appear? A significant part of the answer lies in the debt maturity schedule. During the years of extremely low interest rates, governments around the world issued enormous volumes of bonds. Many of these bonds were issued with medium-term maturities, meaning they begin to mature gradually over the course of this decade. Between 2025 and 2026, a significant portion of this debt will need to be refinanced. This means that bonds issued in a very low interest rate environment will need to be replaced by new bonds issued in a much higher interest rate environment. This transition may seem like just a technical detail, but its implications are profound. When refinancing occurs at higher rates, the average cost of public debt begins to rise rapidly. And this increase is not marginal. In economies carrying trillions of dollars in debt, even small changes in interest rates can generate very significant increases in annual interest payments. This is where the fiscal issue begins to take center stage. Governments may face difficult choices: reduce spending, increase revenue, or continue expanding debt. Each of these options has economic and political consequences. The bond market, however, does not wait for these decisions to be made to react. It begins to price in these pressures in advance. That's why some of the movements we see today in long-term rates may be related not only to the current economic cycle, but also to expectations about how this refinancing process will unfold in the coming years. And when investors start looking at the 2026 horizon, many realize that this period may mark an important moment of adjustment in the global financial system. When we discuss structural changes in the bond market, many people immediately ask, what does this mean for the stock market? This is an important question because the two markets are deeply connected. The relationship between them goes through a fundamental concept of financial valuation, the discount rate. When investors analyze a company's value, they are essentially trying to estimate the present value of the cash flows that company may generate in the future. To do this, these future flows need to be discounted to present value using a discount rate. This rate is heavily influenced by long-term bond yields. When yields are very low, the present value of these cash flows increases. This tends to support higher valuations in the stock market. But when yields begin to rise structurally, the situation changes. A higher discount rate reduces the present value of future profits. This means that, in many cases, the valuation multiples that investors are willing to pay also need to adjust. Historically, periods of sustained interest rate increases create more challenging environments for risky assets. This doesn't necessarily mean the stock market automatically collapses. The economy continues to function. Companies continue to innovate, and certain sectors may even benefit from macroeconomic changes. But the environment tends to become much more selective. Companies with solid cash flow, stronger balance sheets, and less reliance on external financing generally navigate these periods better. On the other hand, highly leveraged companies or those dependent on cheap capital may face more difficulties. This is one of the reasons why macro investors watch the bond market so closely. Seemingly small changes in long-term yields can trigger much larger adjustments in other asset classes. And when these changes are structural, not just cyclical, the impact can extend over several years. It is precisely this type of transition that many market participants are trying to assess now. When the macroeconomic environment begins to change, the way investors make decisions also needs to change. During periods of abundant liquidity and very low interest rates, many assets manage to appreciate simultaneously. Capital is cheap, financing is easy, and the appetite for risk tends to grow. But when the cost of money rises and financial conditions become more restrictive, the market begins to differentiate much more between quality and fragility. It is at this moment that experienced investors turn their attention to some essential fundamentals. The first is credit quality. In an environment of higher interest rates, companies or issuers with weak balance sheets face greater difficulties in refinancing debts. Those with solid financial structures tend to maintain access to capital under more favorable conditions. The second factor is real cash flow. During periods of low money prices, the market often values promises of future growth. But when financial conditions tighten, investors begin to value companies that already generate consistent cash flow in the present. The third point is macroeconomic resilience. Some sectors of the economy manage to weather difficult economic cycles with more stability. Others depend heavily on economic expansion or abundant financing. Understanding this difference becomes fundamental during periods of transition. The bond market, in this context, is not just an indicator of risk. It can also offer opportunities. When rates move rapidly, moments arise when certain bonds offer much more attractive yields than in previous periods. For investors who understand the macroeconomic landscape, these distortions can represent interesting positioning opportunities. But identifying these opportunities requires something many market participants ignore: a clear understanding of the structural forces shaping the global financial system. And that's exactly what we're trying to understand by observing the signals coming from the bond market today. If there's one consistent lesson the bond market has taught throughout financial history, it's this: major economic movements rarely begin with a dramatic event. They begin with subtle signals. Small changes in long-term yields, gradual shifts in the yield curve, changes in the behavior of large debt buyers. These signals often go unnoticed by the general public. After all, the bond market doesn't usually generate the same attention as the stock market or other more volatile assets. But for those who follow closely, these movements act as an early warning system. Throughout this analysis, we have seen how several structural factors are converging simultaneously. A highly indebted global system, a higher interest rate environment after many years of extremely cheap money, gradual changes in the bond buyer base, and a refinancing schedule that could become more demanding over the second half of this decade. When we put all these pieces together, we begin to understand why so many market participants are watching the 2026 horizon with increasing attention. This doesn't mean a crisis is inevitable. The global economy is dynamic, and monetary and fiscal policies can evolve over time. Adjustments can happen gradually, and the system can find new equilibriums. But ignoring the signals coming from the bond market has never been a prudent strategy. Investors who can interpret these signals in advance are often better positioned to navigate periods of economic transition. And this, in many respects, is the essence of macroeconomic analysis. It's not just about reacting to what has already happened. It's about carefully observing the forces that are forming beneath the surface of the financial system. Now, if you want to continue learning how to interpret these signals and understand how major economic shifts begin to take shape before they make headlines, subscribe to the channel, because understanding the bond market isn't just a technical matter. It's one of the keys to understanding how the global financial system really works, and to better preparing for the upcoming economic cycles.